If you checked the U.S. Treasury market this morning, you weren't just looking at a red dashboard or a typical day of volatility. You were witnessing a historic turning point, the financial equivalent of a tectonic shift. Imagine a scenario where the world's most loyal financial partner, cornered by extreme economic necessity, is forced to prioritize its own survival over a decades-old alliance. What we saw on January 6, 2026, was a fundamental shift in global power, driven by the release of $1.2 trillion in U.S. debt into an already fragile liquidity environment. This isn't just about numbers on a screen, it's about the very plumbing of the global financial system being rerouted. The architect of this move isn't a geopolitical rival or a nation under sanctions. It is Japan, long considered the anchor of American financial stability in Asia. They have just triggered a restructuring of their U.S. debt portfolio on a scale that defies modern precedent. While mainstream outlets are quick to characterize this as a routine currency intervention, the reality is far more complex and significantly more consequential. This is a defensive mechanism for survival. It is a mandatory rebalancing that signals the end of an era of predictable bond markets. The smart money is already scouting for new safe harbors, leaving the general public to navigate a system that is changing in real time. Today, we conduct a forensic analysis of the data that few are willing to discuss. Let's reconstruct the timeline of this financial event. On January 6, 2026, at exactly 8:47 p.m. Eastern Standard Time, a technical update appeared on the Bank of Japan's BOJ website. There was no televised press conference, no grand fanfare, and no warning to the international markets. It was a single PDF document, released in Japanese first, with a delayed English translation. The core message: Japan was implementing decisive measures to stabilize the yen. In the coded, professional language of central banks, this was a signal for a massive seismic shift. To the uninitiated, it sounded like boring bureaucracy. To the high-frequency algorithms, it was a direct order to reposition. Within 90 minutes of that PDF release, the Treasury futures market in Chicago began to show signs of extreme stress. The ALGOs detected a massive migration of capital before any human analyst on Wall Street could even finish their first cup of coffee. By midnight, the 10-year Treasury yield, the benchmark for global borrowing, had surged by an unprecedented 42 basis points in a single session. This is what insiders call a gamma flip, a phenomenon where a massive stakeholder stops maintaining their position and begins an aggressive liquidation, forcing market makers to sell even more to hedge their own risk. As of late 2025, Japan was the largest foreign creditor to the United States, holding over $1.1 trillion in Treasury securities. For over 40 years, the silent pact was simple. The United States provides military security in a consumer market, while Japan recycles its trade surplus into American debt to fund U.S. deficits. On January 6, that pact was adjusted. The gentleman's agreement that underpinned the post-1945 financial order has officially entered a period of fragmentation. The survival paradox of the yen-Japan is trapped in a survival paradox. Since 2022, the yen has devalued significantly, spiking to 161 per dollar in early 2026 for an island nation that imports almost all its energy and food. This is a slow-motion economic catastrophe. With a debt-to-GDP ratio of 264%, Japan cannot raise interest rates without triggering a domestic debt spiral. Their only remaining lever is to liquidate their massive stockpile of U.S. treasuries to buy back yen. They are choosing their own currency stability over the stability of the U.S. bond market. The Liquidity Cascade. This creates a liquidity event. U.S. treasuries are the primary collateral for the repo market, the multi-trillion-dollar overnight lending system that keeps global banks functioning. When Japan liquidates hundreds of billions in treasuries, they are effectively pulling the pipes out of the global financial plumbing. Algorithms detect this shortage of high-quality collateral and trigger automatic sell orders, creating a liquidity cascade. As prices drop, margin calls are triggered, forcing further selling and pricing in the potential for a systemic freeze. Japan versus China. The strategic contrast. While China has reduced its holdings strategically over 3 years, Japan's exit is an emergency response. It is unplanned, and born of necessity. When your most loyal ally is forced to sell, it sends a terrifying signal to the world. It suggests that the U.S. Treasury may no longer be the risk-free asset that can be held indefinitely during a crisis. The Great Disconnect, paper Vs, physical assets as faith in the debt-based system wavers, smart money is migrating toward assets with no counterparty risk. Currently, the gold-to-silver ratio is hovering at an unusual 88:1. There is a growing disconnect between the paper price on the exchanges and the physical reality in the vaults. Sophisticated investors are noticing that, while the digital price of silver is suppressed, physical premiums are reaching 30%. They are seeking unobtainium, physical assets that cannot be devalued by a central bank statement. The Federal Reserve is now facing what we call a checkmate scenario. They have two paths. The path of austerity, let yields rise to attract new buyers. But if the 10-year yield stays high, mortgage rates hit 10%, the housing market freezes, and corporate borrowing becomes unsustainable. The path of intervention. The Fed restarts quantitative easing, QE, printing new dollars to buy the debt Japan is dumping. This suppresses yields but destroys the dollar's purchasing power, signaling that the U.S. can only fund itself through inflation. We are witnessing the restructuring of the global economic order. Japan's pivot is merely the first domino. When the vassals of the empire begin to prioritize their own survival over the empire's currency, the endgame is no longer theoretical. The era of risk-free government debt is facing its greatest test. Discerning investors are pivoting toward assets that preserve value independently of central bank policy. What is your strategy? Do you rely on mainstream reassurances, or do you observe the actual movement of smart money? Verify the data. Watch the bid-to-cover ratios and the premiums for physical metals. These are the true indicators of the world we are entering. Let me know in the comments. How are these yield spikes affecting your local borrowing costs? Hit the subscribe button and turn on notifications. In a crisis this fast, being 24 hours late is the same as being wrong. Stay sharp, stay liquid, and always stay one step ahead. The system is choosing its path. Make sure you have chosen yours.
While the world was distracted by the festivities of late December 2025, something predatory was moving in the shadows of the global commodities market. While most investors were checking their holiday balance sheets, the silver market was being ripped apart by a 20% gain in a single week. Think about the sheer scale of that move. In a market that usually fights for pennies, silver jumped 10% in a single day, on a day when most banks weren't even officially open. But here is the paradox that should keep you awake at night. As the paper price on your screen touched a staggering $83 an ounce, the physical shops, the boots on the ground, were slamming their doors shut. Today, we are peeling back the curtain on the silver chaos of 2025. We are talking about a market where the institutional banksters have finally lost the remote control, where China is quietly choking the West's industrial supply, and where large-scale institutional capital is no longer asking for the price, they are just asking for the delivery. If you think this is just a retail pump and dump, you're missing the biggest geopolitical heist of the decade. This isn't just about coins, it's about the collapse of the paper illusion and the birth of a new, brutal reality in the US-China economic war.
Let's look at the forensic evidence of what just happened. Silver didn't just move, it teleported. We saw a weekly close at $68.97, which was already an elevated level, followed by an unprecedented surge. For a moment, late on a Sunday night when liquidity is thinnest, silver was trading in the $80. But the real story isn't the price on the screen, it's the chaos in the physical market. Reports from veteran dealers across the United States are painting a picture of a broken system. Shop owners who have been in the business for decades are reporting that despite being officially closed for the holidays, their phones haven't stopped ringing. The financial elite, the players with 5- and 6-figure orders, have officially woken up. What is most shocking is that these whales weren't buying when silver was at $30 or $40. They're buying aggressively now at $70 and $80. Why? because they've realized that the spot price is becoming a lie. Last week, we saw an $11 drop in a matter of hours. To the uneducated observer, that's a crash. To the veteran fund manager, that's a liquidity grab. When the price hits an all-time high, massive institutions trigger a sell-off to hunt the stop losses of retail traders, only to scoop up the physical metal at a discount. The paper price says 72, but if you want to sell, they'll pay you 62. If you want to buy, you'll pay 80. The middle ground has vanished.
For years, the West treated silver as a decorative asset or a speculative play. China treats it as a strategic weapon. As the world's industrial juggernaut, China has been quietly limiting the export of silver throughout 2025. They need it for their solar dominance, their EV revolution, and their massive AI infrastructure build-out. By choking the supply, Beijing isn't just raising the price, they are effectively deindustrializing the United States. If American tech giants can't get silver, they can't build the future. We are seeing a net zero trap where the West's green energy goals are being held hostage by a metal they forgot to secure. China isn't just hoarding silver, they are weaponizing it. But last week, the iceberg orders hit the COMEX. Large entities, likely a combination of Eastern central banks and massive sovereign wealth funds, demanded physical delivery. They didn't want a digital receipt or a cash settlement. They wanted the bars in their vaults. When the short sellers tried to cover, there was no metal to be found. That 20% spike was the sound of the paper manipulation machine grinding its gears and exploding under the weight of real-world demand. The corporate Hunger Games. We are now entering a phase where retail investors are competing with corporate giants like Tesla, Apple, and Samsung. These corporations have realized that silver is the new oil. Do you think a trillion-dollar company cares if silver is $70 or $90 when they need it to keep a multi-billion-dollar production line running? They will pay whatever it takes to secure their supply chain. This creates a liquidity squeeze, where the average person is simply priced out or blocked from buying because the big players have already cleared out the inventory. Is this $11 correction the end of the run? Hardly. In the world of high-stakes trading, this is what we call a shakeout. The volatility is designed to scare the weak hands, the retail investors who bought at the peak and don't have the stomach for a 10% dip. But look at the underlying metrics. Even after the drop, silver is still sitting above $70. 1 week ago, that was considered an impossible dream. The market is establishing a new floor. We are also seeing a massive decoupling. The price you see on major exchanges is becoming disconnected from the reality of the refinery. When refiners refuse to pay near spot, it means they are overwhelmed by sell orders from panicked retail, but they are also struggling to source pure metal for their industrial clients. This chaos is the labor pains of a new financial system where hard assets, not digital promises, dictate power. The US-China battle over silver is the ultimate proxy war. If the US cannot break China's grip on the physical supply, the Green Revolution will be made in China exclusively. This is why the volatility is so violent. We are watching the price of a strategic military and industrial asset being revalued in real time. So, what is the endgame for the silver chaos of 2025? The events of this past week have proven that the silver market is a coiled spring that has finally snapped. The $11 correction isn't a sign of weakness, it's the market searching for a new, much higher equilibrium. The big banks are retreating to their secondary lines of defense, and they will use every media outlet at their disposal to tell you that the silver squeeze is over. But ask yourself, if it's over, why is China still hoarding? If it's over, Daisao, the financial elite, are buying the dip at $70. And if it's over, why are physical premiums behaving like a fever dream? The truth is, we are entering the period of true price discovery. We haven't seen the real value of silver in over half a century because of the paper chains. Those chains are broken. We are moving toward a world of unobtainium, where having the metal in your hand is the only thing that matters. Don't let the flash red on your screen blind you to the shining white reality. The dollar is fading, the East is rising, and silver is the lightning rod for the entire transition. The final question remains: when the dust settles and the market realizes that there isn't enough physical silver to satisfy even 10% of the standing buy orders, where do you think the price will stop? Leave a comment below. While you were sleeping, the rules of the global financial game were rewritten. In the world of high-stakes trading, we are taught that markets are a transparent reflection of supply and demand. We are told that the best man wins based on data, logic, and timing. But last night, 41,000 traders learned a brutal, expensive lesson. The house doesn't just play the game, the house owns the board, and when the house is about to lose, it simply flips the table. Imagine the scene. It is Monday morning. You've done your homework. You saw the massive demand for silver in Asia. You saw the supply deficits. You bought in at $65, watched it climb to $80, and you were sitting on the trade of a lifetime. You were winning. But as you slept, a silent execution was carried out in the back rooms of the Chicago Mercantile Exchange. In a matter of hours, a staggering $8 drop in silver wiped out billions in retail wealth. But here is the kicker. It didn't happen because of a sudden surplus of silver. It didn't happen because the economy suddenly got better. It happened because the COMEX decided to pull the rug out from under the buyers to save the sellers. Tonight, we are investigating the silver market massacre. We're looking at the 41,000 liquidated accounts, the suspicious $88 to $74 price gap between Shanghai and New York, and the silent economic war between the US and China over the one metal that powers the future of green energy. Was this a risk management move by the exchange, or was it a desperate attempt to stop a systemic collapse of the banking giants who bet against silver? This isn't just a market update, it's a forensic look at a financial crime in progress. The forensic evidence from Monday morning, December 28th, reveals two parallel realities separated by a wall of manipulation. In the East, Shanghai silver opened at a massive premium, converting to roughly $88 per ounce, a reflection of the genuine physical hunger for metal in Asia. In the West, however, the COMEX in New York hammered the price down to $74, a 6% crash triggered not by lack of demand, but by a sudden increase in margin requirements. By raising the cost of holding a position from $22,000 to $25,000 per contract without warning, the exchange created an immediate cash crunch. Traders who couldn't find thousands of dollars in cash within hours were forcibly liquidated by their brokers. This created a waterfall of selling that wiped out 41,000 traders. This move was perfectly timed to prevent silver from crossing the $75 strike price, where 205 million ounces of silver would have been demanded for physical delivery, a demand the COMEX simply could not meet. Now let's peel back the curtain and talk about the big picture. This isn't just about a few traders losing their shirts. This is a symptom of a much larger, much more dangerous conflict, the geopolitical war for physical assets between the declining American empire and the rising Chinese industrial machine. The arbitrage gap, West versus East. For decades, the West has controlled the price of silver through paper trading. We trade receipts for silver, promises of silver, and digital shadows of silver. But China is playing a different game. China is hungry for the physical metal. The $8 to $14 spread we saw between Shanghai and New York is a massive alarm bell. It tells us that in the East, where they actually use the metal for manufacturing, the price is significantly higher. In the West, where we use silver as a financial instrument to hedge bank balances, the price is being artificially suppressed. China is effectively vacuuming the physical silver out of Western vaults because it's so much cheaper in New York than in Shanghai. This is a massive transfer of real wealth from west to east, hidden behind a screen of volatility. Protecting the too big to fail. Who benefits when the silver price crashes? The short sellers. And who are the biggest short sellers in the world? The massive bullion banks, the very institutions that the COMEX is designed to protect. If silver had hit $90 or $100 last night, a handful of major banks would have faced losses in the tens of billions. They were staring into an abyss. By raising the margin requirements, the COMEX effectively gave these banks a get-out-of-jail-free card. They forced the retail buyers to sell, which allowed the massive short positions held by institutions to be covered at a massive discount. It's the ultimate irony of the free market. When the little guy is losing, it's called market discipline. When the big banks are losing, it's called a systemic risk, and the rules are changed mid-game to ensure the elite survive. The industrial endgame. Silver is the new oil. We are entering a net zero era, and you cannot build that era without silver. Every solar panel, every electric vehicle, every 5G tower, and every advanced weapon system needs silver. It is the most conductive metal on the planet. There is no substitute. We are currently in a multi-year supply deficit. Mines aren't producing enough, and the green revolution is devouring every ounce. What we saw last night was a paper crash hitting a physical wall. The COMEX can manipulate the margin requirements all they want. They can liquidate 41,000 or 400,000 traders, but they cannot print more silver atoms. The institutional giants, the sovereign wealth funds, and the industrial titans, they aren't selling. They are watching this crash, and they are buying. They know that every time the COMEX shakes out the retail traders, it creates a temporary fire sale for those who have the cash to take delivery of the real, physical bars. The West is sacrificing its long-term industrial security to save its short-term banking stability.
Is the silver bull dead? Hardly. What we witnessed was perhaps the most bullish signal in history. You only change the rules when you were terrified of losing the game. By hiking margins 14% overnight, the COMEX didn't stabilize a market, they exposed their own insolvency. The 41,000 liquidated traders were the casualties of a war they didn't know they were fighting. This crash proved that the COMEX is no longer a place for price discovery, but a fortress for price suppression. Silver is now a coiled spring. Every paper manipulation only increases the pressure on the physical supply. Eventually, the gap between the fake price in New York and the real price in the East will cause the entire system to snap. The question isn't how high the price will go, it's whether you will be holding physical metal when the house finally locks the doors. Was this a legitimate move or a blatant bailout for the banks? Tell us your thoughts in the comments below. Subscribe to stay ahead of the next rug pull. In a world of paper promises, the metal is the only thing that is real. Stay safe, stay liquid. We'll see you in the next one.